We're in finance, and this is monitoring and managing your cash flow. We are going to go through understanding cash flow and the profit first approach. The profit first, which is our new perspective on cash flow management and how profit first actually aligns with cash flow and your business sustainability. So the main element you've heard here is cash flow. We are going through the cash flow principles. So let's take a look. I'm just going to get my head out the way there. The difference between traditional cash flow versus the profit first models. In traditional accounting, profit is what's left after all expenses have been deducted from the revenue. So we've seen in the previous lesson about financial forecasting, you've got income less expenses equals profit. Now the cash flow, on the other hand, is the net amount of cash moving in and out of a business at a particular time. While profit is a crucial measure of success, it doesn't necessarily guarantee a positive cash flow. This is because cash flow also considers the timing of income and expenses, which can significantly affect a business liquidity. So the profit first model actually flips that traditional accounting method of sales less expenses equals profit into sales less profit equals expenses. So what we're actually doing there is we are prioritizing how much sales we need in our financial forecast, and we're also looking at how much percentage profit or dollar value profit we want to achieve, and then making sure that our expenses actually fit into that, as opposed to going, this is how much, as opposed to setting the target of this is how much revenue we've got, this is how much it costs for our expenses, and finding out that there is, in fact, 1% of net profit left over. What we're actually saying here is pick your revenue, estimate your revenue targets, and then also have a preconceived idea of what profit margin you want to achieve, and then run your company with the amount left over or less. So this model forces businesses to adapt their expenses to what's left after your profit. It can lead to a more disciplined cash flow management and cost control. It is definitely not accountants' favorite way of you going about your money management and your cash flow. However, this is a really important thing if you do want to maintain profitability. It's a good way to be able to go, and this is my experience, I've got a non-negotiable for less than 10% net profit. It have to be there. There is no way we will let expenses get larger than that. And you might have something like that in your own company as well, whether it's 15, 20, 25%, wherever your number is. You want to have a non-negotiable of this is the minimum amount of profitability that we want to run in order to be successful. Now, the impact of cash flow on business growth and stability through the profit first view. So cash flow plays a significant role in the business growth and stability. A business with a healthy cash flow can invest in new opportunities, whether it's financial downturns, and meet its financial obligations, which all contribute to long-term stability and growth. In the profit first perspective, cash flow management is directly tied to profitability. It challenges businesses to continually evaluate and adjust their operating expenses to ensure they're not outpacing their revenue. This approach not only maintains positive cash flow, but also enhances business stability through regular profit allocation. It leads to a business growth model that's rooted in sustainable profitability rather than just growing for growth's sake or growing revenue. So going into part 2, strategies for improving cash flow in a profit first model, we want to go through things like prompt invoicing, credit terms, and collections. So in the profit first model, managing accounts receivable effectively is so crucial for maintaining positive cash flow and ensuring regular profit allocation. Businesses can implement the following strategies. We've got prompt invoicing, invoice as soon as you can, or as soon as your services are rendered, or delivered, and payment collection, to speed up your payment collection and improve cash flow. We've got credit terms as well. You want to set clear and firm credit terms and make sure clients are aware of them. Consider offering discounts for prompt payment or incentivize quick settlements. And there's also a collections option as well. So monitoring accounts receivable very closely and follow up promptly on overdue invoices, and then establish a system or systematic collection process to manage your outstanding payments as well. This could include things like sending out a letter of demand. These strategies also help you improve your regular cash flows, which is necessary for taking profit first and managing expenses with the remaining cash. Now, going into controlling accounts payable with profit first, and also negotiating payment terms and maximizing early payment discounts. So the profit first model advocates strict control over expenses And this includes managing accounts payable effectively. So you might go through and negotiate your payment terms, work with your suppliers to negotiate favourable payment terms that align with your cash flow cycle. This could mean extended payment terms or staggered payments. I think the element here to go through or to consider is the communication aspect of it. You don't just dictate what your supplier's terms are. It's so much easier to send off an email or make a phone call, negotiate what is a better term for you, and then implement that for the duration of your relationship with them. Also, there are some strategies to be employed around maximising early payment discounts. So if cash flow allows, take advantage of early payment discounts. This not only saves money, but also fosters good relationships with your suppliers as well. So if you want to keep them on side, you need the money in your pocket now and you can afford, you've got the margin to be able to give early payment discounts, then that's definitely a strategy that could be employed for your company. And by managing accounts payable strategically, businesses can control cash outflows and ensure they have sufficient cash after profit allocation to meet their financial objectives. Now, bank account structures, this is the last part that we haven't really touched on of how to actually implement the profit first principle. So in order for profit first principle to work effectively, you'll need to open multiple bank accounts within your business bank. This will enable you to assign a percentage of each invoice to the correct account, ensuring you always eat first. So open a business banking account with your preferred bank, create 4 accounts. We want 3 transaction accounts and 1 savings account. You'll title them as follows. 1 transaction account will be income, 1 transaction account will be tax, 1 transaction account will be bills, and the savings account will be profit. Once you begin trading, a percentage, well, if you're already trading as well, you want to pick, say, the start of a month would be a great time to do this, or at the end of financial year. And you want to begin by putting a percentage of every dollar that enters into your income account, which is your normal trading account, will be a percentage of that will be portioned to each of the other respective accounts. This will assure you have enough cash to make your tax payment, pay your bills, have some profit, and also continue advancing forward. So this would be where you would go, okay, well, previously we've said our non-negotiable profit amount is 10%. So let's assign 10% to the profit area. Also, by looking at your financial forecast, you might be able to see, we should be able to see that in order to run your company out of bills, you're going to need, let's say 20%. For tax, you would like to put away 25%, and then the remaining amount stays in income, which runs the company. So that's the kind of thing, those kind of percentages are things you're going to have to figure out yourself depending on how cash moves through your company and also how profitable your company is. But by using your financial forecast, you'll be able to see, you can also enter in your figures from, previous 12 months, 24 months, and see how that looks. And you'll be able to start to identify what those percentages are going to be and just be a little bit flexible for the first 3 to 6 months and let those percentages settle into where they really need to be. And that's the profit first principle. So we understand cash flow, we understand a little bit about the profit first principle and how to use the profit first principles. There is also some great books and some great additional content online if you want to search profit first principles. By all means, I think it's super important for the cash flow of your company.